Good evening, everybody. It is Monday, July the 11th, and we're about 45 minutes after the closing bell. Did you see the 10-year yield today? The move to the downside, the US dollar move to the upside. Safety is definitely out there, and rightfully so. I'm your wealth guy. Let's talk money. Let's talk market preview and market wrap up. All right, everybody. So as many of you already know, I typically do a Sunday market preview. However, I decided to jump in and do it today instead, even though it's not a long weekend. And the primary reason for that is because as I was doing some research on monetary policy and the direction of the currency and the flow of money over the next 6 months, the projections aren't really looking too good, a little bit doom and gloom. So I really wasn't in the right state of mind in order to present that information out there. But don't get me wrong, it will be coming out. Either I'll be reporting on it tomorrow or possibly Wednesday after CPI numbers. But I figured instead what we'll do is for this week only, we're going to do a market preview for the rest of the week, but we'll also do a market wrap up for today. So let's jump right in, because today the markets ended up finishing in the red, which should really be no surprise. The markets opened up in the red last night, or at least the futures markets did, with foreign markets opening. And all throughout the night, all throughout the morning, we were pretty much in the red, keeping in mind that at one point the Dow did turn green briefly before pulling right back down into the red. So at the close today, the Dow Jones closed at 164 in the red, the S&P 500 down 44.95, making it right on that edge, right on the line to slip back into bear territory, and the Nasdaq closed down at 262. Looking at our typical confirming indicators, which are crude, the US dollar, and the 10-year yield. Crude actually, surprisingly enough, finished very, very low. West Texas down $1.31, a little bit off the morning low. But the 10-year yield finished very significantly in the red at 3.55 in the red. A lot of buying here. We're definitely seeing safety trades going on, and that is compounded by central banks buying the debt and buying everything that they can. So the yields were down, which means that there was a lot of bond purchases, and the US dollar just solidifies and confirms the notion that we are certainly in a safety trade this week, or at least for today. With the US dollar sitting at 107, the comparative dollar there, and that's up 1.10 on the day. So overall, again, confirming that we are definitely in the negative territory for the day, at least at the close. And it was definitely a safety trade, to say the least. Some may even call it a fear trade. But I'm not quite there. I think it's a safety trade. I think the markets are preparing for a worse than expected CPI. And that's actually where I am. It's expected that CPI will be at 8.8, even though previously the markets had priced in 8.6. I wouldn't be surprised if we see an 8.9 or even a 9.0. And if we do get that, never mind shadow inflation, but if we do get those numbers that are higher than the 8.8 expectation, we can anticipate the markets are really going to react negatively to that. And I anticipate that the markets will turn very red if that's the case. Now, if we come in at 8.7 or even 8.8, the markets may digest that relatively well, as it shows a flat lining, at least to expectations, even though the reality is it's absolute garbage. Let's take a look at cryptocurrencies today, because cryptocurrencies are still struggling to find their stronghold here, or even a level of support. Although they've been in this tight channel for quite some time, Bitcoin currently sitting just shy of 20,500. Ethereum currently sitting just shy of 1140. Now, I'm still not looking too optimistically here at cryptocurrency. I think there's still a little bit of negative trends to go. We'll actually be talking about the possibility of Bitcoin and crypto falling a little bit further when we talk about fiat currency on the next special video that we put out. But for now, I'm still not expecting very much from crypto. I'm probably going to say it's going to sit within this high 19s to mid 21s for quite some time, at least for Bitcoin. Taking a look at commodities, never mind crude, which was down $1.31 today, at least West Texas was. Gold took another $10 hit, and silver really not doing very well. Both metals are struggling quite a bit. Silver currently sitting at $19, almost even, just up 5 cents there. Now, for myself, I think this is a great opportunity as I continue to back up the truck here and load up on my precious metals, because I believe this is not a recommendation, but I believe that precious metals will become critical in the near future. Again, something we'll talk about on the special report on Wednesday. Now, looking across at the rest of commodities, we can see there was a turn in agriculture where it sat very green this morning and is currently not too bad. Soy tends to be the big producer on the day, or the big number push on the day, up about 6%. Everything else was around the 1% mark. Soy was up $6 today, up 0.5%. Soybean oil was up 1.31. So those tend to be the bigger movers on the day. Everything else is pretty well around the 0.5% mark overall. But that's it for today, as far as the numbers are concerned. The big one I really want to focus on is that 10-year yield, because the fact that the 10-year yield is moving down so aggressively when just at the previous market or interest rate increase by the Fed, we were quite literally on the cusp of a market pullback, a very significant market pullback that could have seen an easy 10 to 20% drop. The fact that the 10-year yield is being artificially supported so incredibly well by the ECB, or the European Central Banks, and the Fed out here, never mind the rest of the central banks starting to step up their bond purchasing game as well. The thing that is funny is that we are not calling it quantitative easing, even though for all intents and purposes, that's exactly what it is, but we can't call it that. Instead, we're going to call it emergency measures, because that's exactly how it was presented to us. Now, for the rest of the week, I do anticipate that 10-year yield will continue to drop, especially as we approach CPI. Again, if CPI tends to be better than expected, or at least match expectations, we can probably see a little bit of a reversal there and a move to the upside. However, the odds are we are at least going to see a match, I think, and I wouldn't be surprised if it was slightly worse. Very speculative in that comment, but that's exactly where I'm anticipating and how I'm preparing my own portfolio for the coming week. The other thing I want to point out is that it is earnings, and earnings can always surprise certain sectors. I'm not really expecting too much, only because the CPI number will significantly outweigh whatever we get out of earnings. Now, we're already 7 minutes in, and we haven't even talked about really the rest of the week. I anticipate that the rest of the week is going to be quite volatile. I initially thought we might see a little bit of a slower move, or a little bit of a subdued market tomorrow as we go into Wednesday, but I think we probably could see a little bit of a red day. I'm not anticipating any extreme volatility, not an 800 or 1,000 point dip, but we may see something very similar today, where the Dow might finish 100 points or change in the red, but I wouldn't be surprised if the markets move to the upside. The main thing here is we need to see the US dollar come down and crude move to the upside in order to get that confirmation to the upside. Following the CPI numbers, I think we can expect, if CPI matches or is better than expected, you can expect a little bit of a market rally here. I am not bullish on this market whatsoever. In fact, I think this is entirely a dead cat bounce, and I expect anything we get at this point will be short-lived before the reversal back down to the red. Again, something we'll talk about in the special report and why I believe that. However, that could be an opportunity for you to possibly recapture some gains and exit at a slightly better price than today. But essentially, I do feel that at this point, the US Fed, in addition to central banks around the world, are really preparing for a soft landing here in the markets. I think they are preparing for a very slow decline in the US dollar, the economy as we move into recession, and the eventual pivot from interest rate hikes to focusing on the recession rather than inflation, which will certainly impact the markets going forward. But for now, that's it. Slightly negative probably tomorrow. Depending on what we get CPI, markets could pop a little bit here or bust. We'll see. I will definitely keep you posted, and I will see you tomorrow morning at the opening bell.